Very good evening, one and all, to our update this evening on the MPC. And I'm Aarti Marianis, the Regional Head of South for Union Asset Management Company. And today we have Mr. Parijat Agarwal, who is our Head of Fixed Income, who will be taking us through the current updates that we've received today from the MPC meeting. Just a bit of a background about my colleague, my senior colleague, Mr. Parijat. He has over 25 years of experience on the fixed income side. He's been on both sides of the table, been a head of treasury as well in the past with the State Bank of Mauritius. And prior to joining Union Asset Management Company in 2010, Pari was actually heading the fixed income for SBI Mutual Fund. So it's wonderful to have you here, Pari. And
thank you, Aarti.
Thank you all the participants who've logged in from the length and breadth of the country to hear us out. We really take this as an honor that you're with us today. And we also have the fixed income team members, co-fund managers, Mr. Devesh Thakur, who's joining in the call, and maybe Anundyo too may join in a while since the extended trading hours of has happened today. They would be joining in a couple of minutes. So without any further delay, I hand over the call to my colleague, Mr. Parijat. Over to you, Pari.
Thank you, Aarti, and good evening, friends. So today's MPC call was, I would call it as a continuation of what the MPC delivered on 4th of May. So I have prepared a presentation, a small PPT, to give in detail the deliberations of the MPC today. Yeah, I have shared the screen. So yeah, is it visible now?
Yes.
Aarti?
Yes.
Yeah. So today's, the monetary policy, as I said, it is a continuation of the policy announced on May 4th, which was an off-cycle policy. So today also, the MPC hiked the repo rates by 50 basis points. So now the repo rate stands at 4.9%. Earlier it was 4.4%. So the hike was 50 basis points. So accordingly, the LAF corridor, what we call is liquidity adjustment factor corridor. So standing deposit facility stands 25 bips lower than the repo rate, which would be at 4.65, and MSF, that is marginal standing facility, stands at 5.15. So this is was on expected lines. The markets were expecting RBI to continue its rate hike cycle. Another important point to note from this policy was that MPC also decided to focus on withdrawal of accommodation. So the wording exact like to remain accommodative has been dropped from this policy. What exactly it means is that in a true sense, RBI has said that the policy would remain accommodative, but but it would be in order to maintain the inflation target within the comfort zone of RBI, that is 4% plus minus 2%. So it is no more accommodative what it was during the pandemic period. Now it is moving towards a neutral stance with a rate hike cycle continuation. So now the another factor to note here is that the RBI mentioned about liquidity, because that's also one factor which is inflationary, as well as it supports the market growth. So overall system liquidity remains in large surplus. That has been one of the I would call it as a issue with the the MPC, because a large surplus tends to be inflationary in nature, and The MPC was of the view that it needs to be brought down, the surplus or excess liquidity which was created during the pandemic to support the financial markets. So obviously, in the last MPC, the RBI hiked the CRR by 0.5%. So it moved it from 4 to 4.5%. The impact was seen was that the surplus liquidity used to be in the range of 7.4 lakh crores. It came down to 5.5 lakh crores. And going forward, it is expected that there will be gradual withdrawal of this liquidity, and over a period of time, the goal of the MPC is to keep the liquidity in a neutral state, which is 1.5% of NDTL. So that's where it is, the policy is, attempting to move towards. So a rate hike, a gradual withdrawal of accommodation and liquidity, what it means is that over a period of time, we could see the rates to move up both on the short end as well as on the long end. Now, what was the factors which has brought about the sudden change in the MPC's stance and the rate hike cycle which we saw from the last two policies? The first and foremost is that the inflationary expectations or the price pressures which is visible in the domestic market, globally, in the commodity prices, which is very, very evident in the crude oil prices, which is at $122 a barrel as I speak. The food prices, which has remained elevated as it kept on moving up globally, and the other commodity prices, which have kept on moving up because of supply shocks. Obviously, a large part of the inflationary pressure that we see in the domestic market is imported because of the commodity prices and the global food prices, and the normalization of the liquidity and monetary policy by advanced economies. So that obviously puts pressure on the INR. So we tend to import inflation. So with this backdrop, in order to maintain the inflation within the RBI's comfort zone, RBI started on this rate hike cycle. For the last 4 to 5 months, we have seen that inflation has remained upwards of 6%. Rather, it is hovering closer to 7% for more than 4 to 5 months. So now, in order to bring it back to below 6%, RBI has to tighten the monetary policy. Now, in this policy, RBI detailed the inflation and growth projections. For the inflation, RBI is of the view is that for the first 3 quarters of this financial year, the inflation is expected to remain above 6%. And it is only going to come below 6% in the fourth quarter of this financial year. And for the full year, they have increased the projection by 100 basis points from 5.7% in the April policy to 6.7% in this policy. That's a substantial jump. And looking at, they have also mentioned that, going forward, the global headwinds would continue to put upward pressure on the prices. So there has been, the input prices have gone up because of higher commodity prices, and that is showing as cost push inflation. So that's where RBI started on this rate hike cycle. On the growth front, RBI and the MPCs of the view that for the full year they have maintained the projection at 7.2%. The economy has started to recover. It is on growth, growth trajectory. The things have started to move, and that's why the RBI or the MPC moved their priority to tackle inflation and then growth. So that's how the priorities have changed as of today. Now, this is a chart, where we have depicted the liquidity and the various rates, which is the repo rate and the standing deposit facility rate and the 10-year benchmark. So today, when the after the policy, the 10-year is traded or closed at 7.49, that is 7.5%. The liquidity continues to remain in surplus. It is as of now the daily the adjustment is 3.5 lakh crores, but the overall, including the various other liquidity measures, is towards 5 lakh crores, upwards of 5 lakh crores. That is the total liquidity. So that surplus would be withdrawn over a period of time. That's where the policy is endeavoring towards, so that the overnight rates, which are at the lower end of the STF, which is closer to STF, the endeavor of the RBI is to move it towards the policy rate. That's where the all the monetary policy measures are aimed at. When RBI also mentioned about how the growth has started to pick up. So however, they have still maintained the full year GDP growth at 7.2%. If you look at this chart, the credit uptick has started to happen, and signs are of recovery in credit growth has started as the economy heals, and recent numbers have actually started showing much better growth, if you can see from this chart. So it is much above the deposit growth. So that's also one factor that when this starts to happen, when the credit growth starts to pick up and starts moving above the deposit growth, so that's where when the inflationary pressure starts building up gradually over a period of time. So that's also one factor which the MPC kept in mind when they hiked the repo rate. This chart is the high frequency leading indicator which we prepare in house. This is also showing a substantial improvement in the growth numbers, the various indicators which points towards the economic health of the country. So it is also showing an upward trend. So another factor to note here is that which has come out in favor of growth, picking up, and it could also put pressure on the inflation, is that the capacity utilization has started to improve. So what it was around 72% has moved to 74%. So that's a very healthy sign for the growth numbers. So it shows that the economy has started to heal, and over a period of time, we could be back to pre-pandemic levels. That's where it is. It points towards. The consumer surveys on employment spending shows also some improvement, but still remains dampened, compared to pre-pandemic level. So both the urban and the rural, consumption patterns are showing an uptick, but still not what it used to be pre-pandemic. Now, the important point to note here is that the high inflation that we are witnessing today, obviously the MPC has increased the inflation projections to 6.7%. But to note here is that the inflation trajectory remains uncertain because of the evolving geopolitical situation. It started to inch up substantially, after the Ukraine-Russia war, and then we saw that the crude prices moving up, and then your commodity prices moving up. There were supply shocks globally, so logistics issues were happening. So that has put pressure on the inflation. But how it is going to evolve over a period of time, that remains uncertain. But in the near to medium term, the pressure is going to remain. So that's why RBI mentioned that at least for the first 3 quarters, it is expected to remain above 6%. Now, global spillovers is another factor which is putting pressure on uh, the RBI to hike the rates. The policy normalization by uh, tighter monetary policy by central banks across the globe. We have seen by the Fed, by the Bank of England, and recently by the Reserve Bank of Australia, all hiking the rates, by more than 50 basis points in the recent meet. So that's also putting pressure on the our central banks to be in line with the global central banks to with a tight monetary policy. Now, one factor to note here is that when the rates are hiked, the impact of the rate hikes on the inflation comes with a lag. So, what it appears is that in order to tame the inflation below 6%, the policy measures have to be front loaded. What it means is that RBI would continue to be hiking rates with a higher percentages in 2-3 policy meets rather than being by 25 basis over a period of time. So that's why we saw it was 40 basis when they did in April from 335 to 75, again 40 basis, and then now 50 basis. So that's the view, that you front load the rate hikes so that the inflationary expectations are tamed quickly. Otherwise, the secondary effects of the inflationary expectation starts to build in. So that's where we believe that RBI would continue on the rate hike cycle for the next few policies. That's what the inflation trajectory is building in. Now, how the interest rates are going to behave going forward because of these scenarios? As I mentioned, the RBI is going to front load the rate hike cycle. So obviously, markets have also started to build in. So we have seen that the rates have moved up by more than 100 basis points in the recent past, in the last 1 month. So the 10-year is moving at 7.5. Your 1-year treasury bill is at close to 6.10. So that's how it has moved. Going forward, we expect that RBI to hike the rates by another 100 basis points, at least by December end. So that's, it could take the repo rate or the policy rate to 6%, so that, the inflationary expectations that has built up could start to, slow down, and it will be back below 6% within a year's time. So that's how it is expected to play out in the next few months. The one important point to note here is that because of the tight monetary policy, withdrawal of liquidity, rate hike that we saw in the last 3 policies, what has happened is that the impact comes with a lag. But one household survey by RBI, the inflation expectations 3 months hence is down by 190 basis point compared to 2 months back. Similarly, the inflation expectations 1 year hence is down by 90 basis points. So this is how the monetary policy tackles the inflationary expectations, by tightening the liquidity as well as hiking the rates. So it clearly shows that a tight monetary policy would gradually bring down the inflation below 6% in the next 1 year. However, the another factors which have helped or are expected to bring down the inflation over a period of time that we have seen is that government has taken call by reducing excise and VAT on oil, and curtailing exports of wheat, steel, and other commodities or products, so that the domestic prices don't move up substantially. So that would also aid in bringing down the inflation. But whatever said, the global spillovers, the evolving geopolitical situations are going to put an upward pressure on inflation in the near to medium term. The fiscal deficit target for the next year is budgeted at 6.4%, but the kind of subsidies which the government is providing because of the to control the inflation would definitely put upward pressure on the fiscal deficit numbers, because then government would have to come to the market to borrow. Either they have to reduce the expenses, or the robust GST collections would come to aid. But that's still, uncertain trajectory that would become more clearer as we move forward. Markets are going to remain uncertain and volatile. See, the escalation of geopolitical situation is the biggest factor. The accompanying surge in international crude oil and other commodity prices, the tightening of global financial conditions, because as you know, globally all the central banks are withdrawing liquidity, and the biggest one is the US Fed, which is going to run down the balance sheet. So for this 1 year, for the 9 trillion balance sheet, which they want to run down over a period of 3 years. So that's going to put a lot of pressure on the financial conditions. And there is a persistent supply side disruptions, which pose, downside risk in terms of I would call, the inflationary expectations. So in a nutshell, inflation has been put before growth in MPC's sequence of priorities, and MPC would continue to focus on withdrawal of accommodation, and the entire sequence, that we have seen from May till today, tells us that interest rates are expected to move up. Now, the big question which everybody starts to ask is that, what is the terminal rate? Now, terminal rate, which is a rate at which the RBI or the MPC believes that this is the repo rate at which is going to keep the inflation within 6% over a longer period of time. So that's where what is called a terminal rate. So it is going to be very dynamic, because the impact of any rate hike comes with a lag. So, however, looking at today, it appears that somewhere closer to 6% could be a terminal rate for the repo rate. So, that's where, the MPC points towards. So that's where what was about all this, the policy in terms of the rate. Now, one important point to, explain is that, in such a scenario, when the rates are moving up and the cycle is up, what should investors do? What are the products that one can invest in from the fixed income point, where, it would be much more beneficial over a long period of time. A short-term volatility would be there, that one has to understand in this uncertain times. Depending upon the risk, it appears that the shape of the curve, which is there today of the yield curve, it is more like what we call is a bear steepening. What it means is that the short-term rates are going to go up more, so that the yield curve or the term spread would start to compress. What it means is that earlier, if you have seen, the treasury bills used to be around 4.35, and the 10-year used to be close to around 6.85, 6.95. So today the scenario is that the 1 year has moved to 6.10, and your 10 is at 7.5. So the spread between 1 and 10 year is going to compress further. So yield curve would start looking more and more flat kind of a thing, because that's what in a tight monetary policy does, because it also takes away some part of the growth or the demand, because when you tighten the policy. So from that angle, so anywhere, where you have a curve which is part of 2 to 3 years or 2 to 4 years is advantageous to invest in. So like, the corporate bond fund that we have right now, we are running a very low duration, but that's where you start to get a very decent return with low volatility, because your accruals are higher, the maturity is shorter in terms of, and you get a roll down. So you benefit from the hike in interest rate, because the repricing starts to happen at a higher rate, and the as the time goes by, when the rate RBI hikes the rate, the portfolio maturity also starts to drop down. So that's where I believe that investors can benefit by investing in that segment. And obviously, those who are looking for a very short, we have our liquid fund and money market fund, which are less than 1 year, which would be beneficial for people who wish to park their fund for a very short duration. So, and on the long end, yes, the time would come where it would be very, very, attractive, because you can lock in at a very high rate, and then you can see that, the higher accrual and the roll down would start to give you much, much better return compared to your FD rates. So that's how investors should, try to, manage their portfolios. So thank you, and over to Aarti again.
Thank you, Pari. And there are multiple questions that have come in. So Pari, I'm going to be moderating and kind of bouncing them back to you. So take them one by one. So the first question is is from Mr. Vibhuti, who says, what should be our stand right now in terms of the debt investments we have made in the coming 2 to 3 years? So I'm assuming there has been a exposure already taken. What we do now, for the 2 to 3 year horizon?
Yeah. So those who have taken, already are invested. So as of now, exiting would not help. That is what my sense is, because you have already taken a substantial pain. Because as I mentioned, a lot of this rate hike got built in the market, because markets move very fast. It's already been built in. Now going forward, yes, the markets may move up. The 10-year we could see between 7.5 to say 7.75, and depending upon the global scenarios, it can even touch 8, or So that's where the rate can go also. But in such a scenario, I would advise people to stay put where they are. But if they are, at a very short end, they can gradually start moving towards what I call is a 2 to 3 year, bucket kind of a product. And if they have a higher risk appetite, obviously the long end makes very good sense, because, if you lock in your money at 8%, that's a very, very attractive rate to lock in your money at 8% for 2 to 3 years. Because this kind of scenario cannot prevail for a long time. So any, very tight conditions, or you have for a very long period, a very high interest rate scenario, it starts to impact your economy and growth. So obviously everybody is, cognizant of that. So if you have a higher risk appetite, you can stomach volatility, go and invest in very, very long end. But, in a gradual phase, because I don't know which is the, going to be from where it is going to reverse.
Thanks, Pari. In fact, that is like a thread to the next practical question coming in from Mr. Shailendra Natu. Yeah. He asks how to identify peak and bottom levels of interest rate cycles to decide when between long-term and short-term we need to invest.
When to catch the peak and bottom, definitely it is not easy, sir, because there are so many variables which move the market and impact the interest rate. It is not only one variable, but yes, the factors which I mentioned, which I just mentioned, that RBI has already started hiking rates. So you could see that where if there are 2-3 more rate hikes, the supply pressure continues, or this global spillover continues for some more time, and you see that rates moving up by say another 50 basis point. A lot of has already been built in. You can say that you are near to that, but I wouldn't call it as a the peak or whatever. So you are near to that. So that would be a good point to invest in the long run.
Right. Thanks, Pari. The next question coming in from Mr. Sanjay Agarwal, who asks us, what could be the expected yield on Union Corporate Bond Fund for a period of 1 year, is what he's mentioned, and the money market fund of Union for a 3-month period?
1 year corporate bond fund would be definitely, as of now, as I said, that we are running a low duration in that, closer to 1.25 years, because we were expecting rates to go up. So it is upwards of 6% as of now. And the money market would be closer to 5% because it's only 1 year for 3 months. That's what it is. Closer to those levels.
Thank you, Pari. The next question coming in from Sheikh Ansar Ali. He asks us, what is the future of these rate hikes and how will the market react?
Future of rate hikes, that's what I told you, that what we believe is a terminal rate. So till when RBI would hike the rates? Because obviously you cannot go on hiking the rates to control the inflation, because at some point of time, the rate hike and tight monetary policy demands to bring down the demand in such a way that your entire economy starts to suffer. So obviously that is where we look at that, where is that point? So as I mentioned, as of now, we believe that, the terminal rate could be closer to 6%. It could be 580, 6 or 6.25. So in that range, it could be. So we are at 490. So I just said that, we could look at 100 basis points more.
And that's a follow-on question from Mr. Rupesh Kumar, who asks us, if RBI increases CRR as well as repo rate by 50 basis points, then how will the market continue to react?
Sir, CRR is a very, very, tool which is used, rarely to tighten the monetary policy. So if RBI hikes the CRR or believes that, to manage or control the inflation, one more CRR hike is required, we could see a substantial jump in the yields, both on the short and long end, because it sucks out the liquidity, tightens the financial conditions, and puts upward pressure on the yield curve. So that's why last time when the RBI hiked the CRR by 50 basis, we saw that immediate reaction was yields moving up by 50 basis points. So if they do that, obviously, yes, the liquidity which is in surplus would come to neutral very, very quickly, but that would have an impact on financing conditions, and we could see rates moving up across the curve very quickly.
Right. Thank you, Pari. The next question is from Mr. Mata Prasad Pandey. Looking at RBI's projection for inflation, where subsequent 3 quarters are beyond RBI's comfort zone, would it be wrong to assume 75 bips, 25 bips in each policy till December 22, which will take the repo rate to 5.65? Yeah, 50 basis more than the pre-pandemic level, which would be justified due to stagflation, he says. Any comments?
That's what I said. That's what we believe, that RBI would continue to hike the rates, whether they will do 25 in 4 or 50, 40, like that way. So my sense is that the sooner you do, it is better for the to manage the inflationary expectations. So yes, anywhere between 5.75 to 6, the repo rate could be by December.
Thanks, Pari. The next question is from Ms. Preeti Sharma, and her question is, entirely on the short-term debt funds, what are our views coming in over 3 to 6 months?
See, on the short-term funds, like say liquid or money market or up to 1 year funds, I would say, you could expect the returns to keep going up. Now, why? Because 2 things will happen. A, RBI would continue to hike the repo rates. So obviously your repricing would continue to happen at a higher and higher level. The second is that the gradual withdrawal of liquidity. That pressure. So today, what is happening is that the overnight rates are almost 30 bips lower than repo rate. They're closer to SDF rates. In today's press conference, the RBI governor also mentioned that the idea is to take this overnight rate, which is today to closer to SGF rate towards policy rate. So that would also impact on the short-term rates. So the entire curve on the very short end will move up. So the repricing would happen at a higher level. So the returns over a period of time, because of the higher accrual, will keep going up. But you could see intermittent volatility because M2M losses would be there. That you need to keep in mind.
Thanks, Pari. Next question coming in from Mr. Sanjay Kumar Jain. Will you see more hikes?
Yes. Maybe August, then again up to December, we could continue to see hikes. But the quantum and would depend definitely on how the inflation trajectory is behaving.
So the next question is, what are the events lined up which are going to impact our fixed income markets globally?
See, our market would generally or normally are more driven by the US markets, because what US Fed does impacts our market because it impacts the currency. So obviously the US Fed would also meet on 15th and 16th of this month, May, and as in the last policy they had mentioned that they are going to continue hiking the rates by 50 basis. So there the US 10-year is at close to 3%. So obviously there also the terminal rate that they call it, they're looking at 3%. So they'll continue to hike the rates. And also they are going to tighten the monetary policy by withdrawing liquidity. So they're going to run down their balance sheet. So they're not going to buy bonds. Rather, what is on their books, they're simply going to run down or sell it in the market. So financing conditions are going to tighten up. So as it starts happening, we could see a flight to safety because US yields are very attractive today. So foreign flows would happen. So obviously the money would move out from Indian markets to the US markets. So that would put pressure on the INR trade deficit and current account deficit. So that obviously would put pressure on the monetary policy to tighten it, the domestic RBI to hike the rates. So these are the events which are interlinked.
Thank you, Pari. Couple of questions on the YouTube channel. One is, some sense of GDP for FY 21-22 final numbers which have come in. If you could just throw some light on that, the GDP numbers.
See, GDP numbers which came for is at 8.7 for the full year. Obviously, because 2021 was a pandemic year, so obviously 2022 would look good. Only the fourth quarter was much lower because of, again, the Omicron thing was there, so this was lower. But this 8.7% which came was definitely on the expected lines and much better than what was believed to be. So it is what it throws the light is that the growth numbers are gradually moving, pre-pandemic. So this trajectory is showing that. So that's why for the full year this year, because obviously your base effects are higher. So for full year this year, RBI has kept it at 7.2%. So we could see going back to pre-pandemic levels is to be at between 6 to 7%, what used to be the GDP growth numbers.
Thanks, Pari. One question from Mr. Ganesh Zarkar, and the previous one was from Mr. Gopal Rachuria, by the way.
Okay.
Now, this question is from Mr. Ganesh Zarkar, who says, what would be the probable impact on growth if RBI goes on for another 100 basis points hike in the next year?
See, any tight monetary policy definitely has an impact on the growth. Now, as I mentioned, that RBI has already calculated that even if they hike the rates by 100 basis points, the impact which would be there on the growth numbers would still be acceptable and economy would continue to grow at 7.2%. So that's how it has been calculated. But suppose anything beyond that, then definitely, we could see that the growth, getting stifled, and we could see the demand coming down, and we could see the GDP growth suffering. So there is always, a balance between till what you can take the rates and how it is going to impact. So obviously, till another 100 basis points, we believe that, the GDP can still grow at 7.2%.
Thank you, Pari. A couple of more questions coming in from Mr. Alpesh Kotak, who says, what is your recommendation for a 1 to 3 year horizon on the fixed income space?
See, if you cannot take volatility, you want safe returns with less volatility, corporate bond fund is the best product. But if you can take volatility and are willing to stay put for 3 years, the long end funds are the best bet.
Thank you. And Mr. Sanjay Kumar Jain is asking us, which fund will you suggest, in comparison with a savings account where there can be an anytime exit? I think the answer is fairly simple. It should be liquid funds, because if you need anytime access, you need to be either in the overnight or the liquid category for a period of 7 days plus. Is that right, Pari?
Yes. And another important factor today is that, savings account still gives us 3% or 3.5%. Some give 2.7, all these kind of numbers are there. Liquid funds, as I mentioned, because of the tight policy, you could see the rates going up. So, in a few months' time, you could see 5%. So, you have a liquid fund, which is a short maturity fund. You can liquidate in a day's time. You can redeem within a day's time, and you get a much better return.
Right. Thank you. There's one question on the YouTube channel on how should the central bank deal with the zero lower bound on the nominal interest rates? I think the question is more to ask, if nominal rates go negative, how should the central banks react?
See, negative rates, had remained for a very long period of time, the real rates across the globe. But over a period of time, it starts to have inflationary impact. That's what we have seen. So obviously, the idea is that to keep the real rate at least zero or above that somewhere. So the idea of these rate hikes is to move towards that only. And globally, all the central banks have started to do that. So as it starts to happen, the inflationary expectation starts to come down, and you reach a point where it becomes zero.
There are a lot of questions around equity. I'm just going to sum up a few views which we heard from our investment desk this Monday morning, so that, Pari, if you could add on to that later on, probably.
Yes, sure.
So the questions are on, where is the market valuation right now? Which is the safest place to be? Will BAF returns really, be over and above, FD rates? There are various questions on the valuation of markets. So just to kind of give you our house views, what we believe is, after a very long time, we as an organization who track fair value of markets, the fair value of Nifty, we constantly are guided by this. This is like a compass, for the entire investment team, at our organization. And this has been guiding us through the last 4 years to build our positions, to kind of make decisions on NFOs or not, to, know whether to be in a large cap, mid cap, small cap, which sector, which stock. We've been completely guided by fair value. And we are tending to neutral position right now. As an organization, we are slightly, more confident about the valuations shown by large cap compared to a mid or small cap. And in terms of sectors, we are currently overweight financial services, consumer discretionary industries, and industrials and telecom. And we are underweight materials, IT, and utilities. And, while the broader latent demand, which is not coming through, the dampening effect, that we are seeing, we are seeing a bit of a dampening effect on fair value. The bottom line is we are cautiously optimistic on equity. We are recommending entry into equity in a staggered manner, but approaching it with caution. That's in a nutshell about what we heard from the investment team. Pari, would you want to add on something, please?
Yeah, I think that is what our views are on the equity markets also. That we do believe that the growth would continue to happen, but yes, for a long period of time. That's why Aarti mentioned that I need to be cautious because these are uncertain times, global spillovers, as I mentioned, and the valuations are impacted by the high interest rate, so that we all know. So that's why she said. But over a period of time, the equities are the best asset class over a horizon of 3 to 5 year period. So from that angle, you can continue to stagger your investments.
And there is one last question coming in from Mr. Sanjay Kumar Jain again on, in these current situations, will BAF give better returns or positive returns compared to equity funds, pure equity funds, with all the hike happening and probably the roll down playing out? I think the question is around the debt portion playing out much better.
Yeah. So obviously in the BAF, during such times, we run a very low duration in BAF. The idea is on the debt part, not to take any rate call, but to dampen the volatility and give support to the equity valuations. So over a period of time, definitely, the equity markets would outperform. I'm talking about 3 to 5 year BAF, but with low volatility, it would definitely outperform a debt product over a 3 year period, a BAF, because it has a higher portion of equity in this. So from that angle, I would say that if for a 3 year period, a BAF definitely makes a lot of sense.
Thank you, Pari. I think, that brings us to the close of a rapid fire Q&A. And, I must take this opportunity to thank all the participants on the YouTube channel. We have, participants there as well as on the live webinar link here. Thank you for joining us today. And thank you, Pari, for sharing the views with us.
Thank you all. Thank you so much.
Thank you all. Thank you all for being here.
Thank you.
Good day.